All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show. My name is Cyprian Francis, and with me, as always, co-founder, chief trading educator, chief trader at Madison Trading House, Mike Patton. Good morning, Mike.
Good morning, Sip, and good morning, everybody.
We are deep into September. We left our last meeting off talking about what is the Fed going to do? Are they going to raise rates? Lo and behold, they raised rates. They didn't really surprise anybody with these 75 basis points. We've
Right.
been falling since. Today the market's up a little bit. What are your thoughts on everything that's transpired since the last show?
Well, I mean, the like you said, no surprise that they raised rates. Everyone, including myself, was convinced that they would have to raise rates again by at least 75 basis points, which they did. There was a chance they could raise by a full 100 basis points, which they did not. But looking at the big picture, we have a bounce back here in the SPY or SPX today. That's not surprising. I mean, if we think about it, um, after such a big drop down, it's not surprising we have this little bounce back up. So, okay, we get a little rebound. Is it going to last? Probably not. It's probably going to be short lived. We have a little bit of a rebound today, and then eventually things will probably go right back down to what they were doing before. The reason being is that at the end of the day, inflation is a really, really big concern. The Fed clearly does not have it under control. It's anyone's guess what the next inflation numbers are going to be. But we could get some big surprises on the negative side. Maybe we get a big positive surprise. But the one thing I do know, next time they read the inflation is not going to be at 3%. It's not going to be at 4%. It's going to still be up, 7, 8% or more. So in short, they know that they have a lot of work to do. Currently, Wells Fargo is projecting even bigger hikes later. Sorry, I think it's my for a second. But
Yeah, I'm gonna go ahead and throw that article into the chat. The one
yep,
you're talking about, Wells Fargo.
yeah. Sorry, I think my mic is a little fuzzy here. But yeah, Wells Fargo is basically saying that they are expecting that we're going to get a 100 basis point hike between now and early next year. And they now expect that the FOMC to raise rates by about 175 basis points, between now and then. So, in short, they're expecting more aggressive moves, and I think they're right because I don't see how the Fed could possibly get ahead of inflation if they're not increasing the rate at which they're hiking rates. Now, of course, that's bad for businesses. Businesses suffer whenever the cost of money goes up, especially if you have debt. Then it just makes it harder for you to finance your borrowed funds. Also, a side note, just a side note, if the value of a dollar gets stronger, then when you pay your debt, it actually in sense costs you more because your dollar is worth more that you're paying back than it was before. If your dollar gets weakened, like in other words, if I have hyperinflation and I owe some money, okay, well, it's not that big of a deal because the money's not worth that much anyway. My debt actually is technically a little easier to finance, but when the value of your dollars go up, basically it means that every time you spend a dollar towards debt, that's a dollar that would have been buying more stuff if you could still use it. So it's a catch 22. And so doing this, they're actually going to hurt businesses, which of course will slow down the economy, which is somewhat what the Fed wants, but the actual impact could be pretty devastating. And we should also note that the next two hikes are scheduled, or well, the next two rate decisions are scheduled for November 2nd and December 14th. So we got two more coming before the end of the year. And if the Fed raises another 75 basis points each time, they'll put us at 150 basis points. But Wells Fargo's thinking it's going to get to 175 by that time. So that could be very substantial. So for people looking for the silver lining on the markets, I don't think you're going to find it. I really do think that we're going to be under a lot of pressure going forwards. I do think that the market overall has been able to accurately reflect, to some extent, the degree of slowdown that this is going to create. But I do think we still have more downside to come, provided that there are no miraculous changes that occur between now and then. I don't see that happening. I do really think we're on a one trajectory. So either the market goes lower or it just stays where it's at now. But I don't really see this miracle Santa Claus rally that's going to come in and save the day.
Yeah, and when you look at the technicals, we kind of hit that June or July
Yeah.
low, that June. So we're like hovering at those June
Yep.
lows, kind of waiting
Yeah.
to for more bad news to potentially break to the
Yep.
downside. But what you're saying is that based on Wells Fargo, we'll have a full 100 basis points increase, either or 75, 75 or right. So they're the 175 means that they'll have to increase by at least a full basis point during one of these two upcoming meetings,
Precisely.
and that hasn't happened in quite some time, and that would probably be the most aggressive since we've started these hikes.
Exactly. Right. So the market right now, I do think it's accurately reflecting what would happen if we keep the same pace. But if the pace increases for interest rate hikes, then we're lagging behind, and that we need to catch up on moving the valuation of the market lower. So yeah, it's just not. I mean, if you look at it over the last 20 days or so, the last month, clearly the market's been mostly going down. This little bounce we're seeing today, if you look at it in context, it's not that big of a deal. We're just going up after lots and lots of days of going down. So in short, I don't really, and to your earlier point, we are trading right at the June lows. If I zoom in here, we're trading right at the lows that we saw over here in June, right? So that's it, and we're actually trading just below that. So the market now is trying to figure out if we want to stay down here or if we want to go up a little higher. But again, I don't think we're about to see some miraculous rally coming out of this. I mean, if we go up for a few days, that's no big deal. But getting back to levels we've seen last saw in mid August, probably not. Probably not going to be able to get back up that high after all this is said and done. So, in short, if you're holding a long-term portfolio, it's definitely something you got to consider, like finding better opportunities. And of course, that's what the software helps you do.
That's exactly what the software helps you do. And now that you bring it up, let's just go ahead and give everybody a chance to grab a copy for themselves. It's MadisonTradingSoftware.com. Once you sign up, you'll be able to get into the Madison Trading Software, where you'll be able to utilize all these different features. And there's a lot to go through. So, keep in mind that if it's something that you want to get a little guidance from, reach out to the team. As you can see, the software integrates directly with some of these well-known brokers, real-time data feeds, and the idea is to just let it pump out the information for you, so that you don't have to do a lot of the legwork. Right, you're letting the AI and the machines do the learning, and that's what you'll see with a lot of these green and red and orange. And so I'll go ahead and throw in a video into the chat so that anybody can check out that specific feature, because every week we try and talk about different features. So the URL is MadisonTradingSoftware.com. Head on over there. And so, in this show, we try and find these opportunities, right? Like, so today we're talking about, well, the market's going to go down. We think it's going to go down. A lot of the signs are saying it's going to go down, but can we still find opportunities? And I think the answer is yes.
Yep.
And you have to look for specific things. And so let's just go into, one of the picks for today, and that's Biogen, ticker symbol BIIB, which I imagine, during COVID was seeing some action because it was, one of those pharma names,
Yep.
and since has kind of come back to reality. But pharmaceutical industry names might, be able to withstand an overall market downturn because people need to, buy medicine and things. So
Right.
what's the software telling us? What are we analyzing? Is this an opportunity? How can we use Madison Trading Software to gauge a name like, Biogen?
Okay, great question. So, firstly, Biogen was found by the software, so we're just looking for a scan of stocks that have moved a substantial percentage today, and here's one. Now, this stock is currently up over 36%. Now, obviously, this is not a small company, so therefore, their market cap is sitting at 28.4 billion. It was lower, of course, before today, but still not a small company. So, what's going on there? Well, first, let's look at the dashboard, get a summary of who we're looking at. So, firstly, Biogen has over 9,600 employees. It's located in Cambridge, Massachusetts. If I hover over here, Biogen and IDEC merged in 2003. And today they have a next generation antibody drug marketed via collaboration with Roche. Biogen also markets novel multiple sclerosis drugs in Japan. I mean, so they got a pretty international profile. Basically, they got a lot of stuff going on. So, in short, this is definitely a company that's got some history. And when we look at the software, what it's basically telling us is that on the technical trend, up until today, the technical trend has been mostly down. Then all of a sudden, boom, we get the big breakout today where we see up here right now, we're trading at about 270 a share. On the inner circle, as of right now, not seeing any dramatic changes in that, meaning that we're not seeing other than the recent money flow today, we're not really seeing a massive amount of institutional buying. We do see an increase of 0.67% institutional ownership, 66 more buyers, 159 fewer sellers, and two more top tens. With this news, which I'll go over the news in just a second, this may push it into more top tens. So I would definitely keep an eye on this stock going forwards because it is up on some good news. So what was that news? Well, let's go to the dashboard to find out. The huge gain came after the company and its partner announced positive results on Tuesday from their late stage Clarity AD study evaluating, I can't pronounce this name, so I'm not going to try it, but a drug in treating Alzheimer's disease. The news also propelled two stocks of other drug makers, which we'll go over in a second. So basically, what they're saying is their Alzheimer's drugs show positive results, and as a result, bam, the stock price went up. There was another headline here, rose the most intraday since June 2021 after a key clinical trial with its partner showed the therapy slowed the progression of Alzheimer's disease. So basically, what that's saying is that their treatment is slowing the progression of Alzheimer's, which of course is good enough because if you can get it to where it barely progresses at all, it's basically like a cure in that sense. So this is, of course, a major ailment that affects many, many people, elderly people. So, sorry, I didn't realize my phone was still on. Uh, sorry, 1 second here. Let me turn that off. So that basically means that this could be a blockbuster, right? I mean, anything that treats a major ailment that affects a large number of people who are elderly, especially, definitely something that could be a big money maker. Now, if we look at the numbers, the last earnings for Biogen came in fairly good. They beat earnings per share estimates. They gained $5.25. The estimate was $4.09. Previous time, they actually fell short, but this is a profitable company. So if I look at their numbers, they are actually making a net income. They're in the positive, they're in the green. Earnings growth has been fairly flat. And if you look at the yearly history, they were really making good progression up until 2020, and now in 2021 they took a dive. This year they're lower, so you can see the earnings projections are fairly flat. We're not seeing any projection that they're going to make a lot more money in stocks. That's pretty much that's a very bad news thing because if when you look at stock prices, there are always projections into the future of what a company is going to be able to do. So if a company's showing earnings growth now and people think it's going to keep showing earnings growth in the future, then they move prices higher for the stock in anticipation of that result. But if the projection is that earnings are going to be flat, that basically flattens the curve for the stock and makes it impossible for it to go much higher. In fact, usually at that point it starts to go lower because the previous estimates were looking at this growth that we saw over here. But once that changes, that means the stock needs to come down lower to reflect a different growth profile. So, in short, these are the current estimates before today. But as of today, once the analysts have a chance to reevaluate the situation, they may make further projections where they project better growth. So, right now, Biogen would be technically considered too expensive, but given the news, the market has spoken, and the market seems to believe that this news justifies a higher valuation. So, of course, the analysts will input their new projections for for earnings estimates. The company will, of course, do the same. The software will take all that information and make a judgment. So, as of right now, the only thing we can say, which is interesting, this is a very interesting point, is that on the valuation, we're still in the green, even after the pop of 30%. Overall, the stock is ranked as a green as far as its valuation, price to book, price to sales, price to cash flow. Even if we were looking at price to earnings growth and PE ratio, these are fairly good. So this looks like an attractive stock to actually consider. So I would say you're going to have to deal with a lot of volatility after such a big jump. Uh, just I'll show something in past for Biogen just to explain why I say this. Here was a previous, forgot what the news was, but this was in 2021. They had a huge leap in price. And then after that, it all came down gradually over time. So just because the news is good doesn't mean it's going to have a lasting impact on the value of the stock. So for right now, I would say be cautious. But if this news seems to present much bigger growth prospects, then sure. But remember, this downtrend that we see here, the logical explanation for why the stock wasn't able to sustain its price even after some good news is if we look at what was happening fundamentally. If we go back to this tab, sorry, and we look at the date when that happened was in 2021, that jump, but earnings projections have been lowered, and they were projected to go lower to next year as well. So at the time, earnings were projected to decrease. So therefore, it made sense for the company's stock value to come down. So one of the members, I was able to save her from a mistake in buying at that time because she asked that question, should I buy it here? And I mentioned that judging by the numbers, I don't think it's a good buy. As of right now, however, it looks a lot better, but I will wait and see. So for now, I would say I don't think you have to rush into getting into this. If it's going to stay where it's at now, you'll have plenty of opportunity to get in. And once all the numbers have been crunched and the projections have been made, if it does look like a good solid buy, something that has future growth potential, at that point buy it. But until that time, the software basically is saying just wait and wait and see when we get to some solid greens.
If you go to that chart again, I know we've
hmm
talked about this technical component, but that blue line on
hmm
the chart, what does the blue line represent again?
Okay, that represents the projected future range of the stock price. So generally speaking, when you get above or below that channel, there's a tendency for price to be pulled back into it. So as of right now, we are definitively well above the projected price range for the stock as of now. But basically later on, as the stock adjusts, it's going to come back into its projected range at some point. It has to. So therefore, whenever you see these big departures outside of this channel, that's a very good indication that you probably don't want to be a buyer right then and there. It's always better to buy if we're towards the bottom of that channel or if we're somewhere in the middle. If we're at the top, you don't want to buy because most likely you're getting in at a price that's higher than you could have gotten if you just waited.
Yeah, and this seems like a good example where all of the things inside of the company are beginning to improve, and the stock price technically is kind of the last to catch up. But
Right.
over the long run, they are creating a product and solving a big problem. So that can affect the bottom line. And so I like the analysis of waiting for it to kind of come back but in the long term, definitely see curing Alzheimer's as something people would pay top dollar for. So
Right.
good pickup by the scanners. A little bit later we'll go in depth some more onto the valuation stuff on how to use that to identify winning trades. But another name that has come up for you on one of your scanners is a popular competitor, I believe, to Biogen, and that's Eli Lilly, ticker symbol LLY.
Yep.
Is this playing off of that Biogen news?
Yes, it definitely is. So Eli Lilly was up apparently in sympathy for Biogen stock. Biogen went up because of their apparently a surprisingly positive results. Now Eli Lilly is also working on a similar therapy for Alzheimer's. So as a result, since Biogen had a surprisingly good outcome for its drug, Eli Lilly's stock has gone up not as much. It's up 8.27%. Also, I didn't realize this PRTA. I didn't plan on talking about this. I don't know much about this stock, but PRTA Prothena, they're working together. It looks, I believe, collaboratively with Eli Lilly. So as you can see, their stock is up quite a bit as well. It's broken way outside of the projected range it was supposed to be in. But if we look at the numbers, fundamentals are not good. That probably means that they're not making any money. But valuation looks like it's fair. Let's take a look at the fundamentals. Yeah, so they're definitely projected to lose money, but it looks like this is more of a company that's involved in research. More, research companies, they generally speaking do not make money. They have investors that keep putting money to finance their research until they make some breakthrough discovery, some great drug, and then at that moment a bigger company like Eli Lilly will come and buy them out and basically say thank you, and the investors get their money back, and that's it. So right now, according to the software, analysts are projecting the stock to go to an average of $71.86. Lowest projection is $45. That's $7 below where we are now, just under $8 below. So we got a pretty good amount of potential upside on this stock. Now I'm looking at it, somewhere in the neighborhood of almost $20 of upside versus about $8 of downside. So given that it's part of the Eli Lilly, they're working on a similar thing. If you're more aggressive, this might be a stock to get into. And I say aggressive because you have to accept that its full success or failure is dictated by whether or not the drug they're developing actually succeeds. So between the two of them, Biogen and Prothena, probably Prothena will have more of a continual push of buyers, because they haven't actually gotten to the excuse me, they haven't gotten to the end result yet. But for when we're looking at Biogen, we know where it's at. So I think that once the information's out, kind of buy the rumor, sell the fact kind of deal. But the safest bet, I would say, is Eli Lilly, because Eli Lilly is already doing well. This already has a profile. But if you look at the score, what's interesting about the score is it doesn't show green or red at all. It's all yellow across the board. So technical trend recently has been modest. Not a lot of buying or selling. People are just holding. Valuation is mid-level, not bad, not good. Fundamentals are mid-level, they're not getting much better, not getting much worse. But this is a dividend-paying stock, so if I'm going to choose which one I'm going to invest my hard-earned dollars in, I could put it into Biogen. But the truth is, Biogen, in my opinion, it's like a bride in waiting. It's just waiting for something to happen to get it to where it's going to be on a trajectory like this, which is not right now. The other stock, Prothena, more speculative. Obviously, it's in partnership, but if this new treatment fails, Eli Lilly is still going to be around. Prothena, I don't know how many other things they're working on. I have to do the research in the platform. So Lilly looks like a decent opportunity to me. Now, I wouldn't buy it right now for the obvious reason that it's currently trading on the highs. So we just broke out of the top of the projected range. Most likely, we're going to get somewhat of a pullback. However, I will add one caveat that since the month is ending shortly, these channels, generally speaking, are best suited for when you've got more than half of a month left to look at. Once you're at the end of the month, when things start anew, everything resets essentially. So if the stock has already gotten significantly above the top of that channel prior to the end of the month, there will typically be a pushback at first, but you're more likely to sustain a future rally once the market, once the next month starts. So for that reason, I would just say this one is definitely on my radar. It doesn't have the momentum of buying activity for insiders or valuation that I would want. But all things considered, since it is a dividend paying stock, I would prefer to be in something like this that's stable, but at least pays me some money in the meantime. So the dividend right now, it's paying 98 cents a share, which is not bad. It's an expensive stock, but you know, if you can get a little money from holding it, not so bad. And if we get a nice buy signal, I would definitely consider getting into this. But I would want to try to get in when it pulls back. So at the moment, I would say just wait. But when the next month starts, we'll see where things are at. If we get a nice pullback to the lower end or the middle of that channel, that's where I'm going to be looking for the buy.
Yeah, and I would assume that there's a few more biotech names that are just catching, a lift today, based
Probably
off of this news, right? Because you're talking about 30%, Eli Lilly 8%, PRTA. What was that up? That was up
70%,
70
72%.
percent, right? Like those are significant moves
Yep.
that are specific to the industry, right? So.
Right.
That's one of the benefits of using the software, having these scanners, having these automated triggers to identify, movers to the upside and to the downside. And so, if you're taking a look at the software for the very first time, you'll see in the top left-hand corner there's these four boxes, and the idea between those of those boxes is to give kind of a score of the technical, the inner circle, which is people inside the company, their buying and selling habits, the valuation, which is something that we're going to go over here now in looking at what types of things to look for in valuations to identify potential winners, and then fundamentals, right? And so,
Right.
real quick before we go into the valuation, out of
hmm
these four, which one do you look at as the largest gauge to moving a stock in the direction that you want it to?
Fundamentals for sure. But well, yes, fundamentals, but I would also point out that what actually moves the stock is buying. So, truthfully, the inner circle is the one that actually sets things in motion. So, it doesn't really matter what I see down here, green and if it's green in fundamentals and if it's green in valuation, in order for the stock to go up, you need someone to buy. And unless you're seeing a significant amount of buyers coming in, the stock just won't go up. So in a stock like this one, especially, like, you do have to wait until there's a sudden increase in buying. So we went over money flow last week. If you can see money flow increasing and it looks like there's a reason why, then that would be a good timing. So if I've got solid green, and then I'm waiting for this one to turn green, the inner circle, that's great. So I usually evaluate fundamentals first, but I always wait to see when people start to buy as my trigger. I don't want to get in unless I know I'm not the only person waiting to buy right now. It's also important to keep in mind, guys, that just because a stock has good numbers doesn't mean people need to buy now. They could wait. They could wait another month. I mean, sometimes there are other pressing issues, like the fact that the market's mostly going down and that interest rates are rising, and there's all sorts of inflation problems. Yeah, fund managers have other things they got to take care of first. They got to deal with their losses first. But once they get that out of the way, when it's time for them to buy into something new, you see them start to go into stocks like anyone that looks really solid. So I would say Eli Lilly looks generally decent, but I think it's more of a stable bet for dividends. So yeah, I would look at fundamentals mostly as
All
the
right, so
first thing.
let's dig in the valuation, because you
Yeah.
do touch on this tab quite
hmm
often, and
hmm
I get lost, right? I in a way
Okay.
don't know what to look at. I mean, it's pretty simple. Green is good, red is bad, but
Right.
there's levels where you can have some bad and some good, and it still be overall good. So when you pull up this tab, where do you usually start your analysis?
Well, it's a good question. I just literally just see it. I first, of course, see the color before I get there, and then I just go literally one, two, three, four, five. Like I go to this one PE first, price to cash flow second, price to sales third, price to book fourth, and then I look at this fifth. I do not always look at the projected price because generally I can get a better idea of the projected price by looking at the fundamentals tab. But this is a useful tool, which I'll save for an entire episode because this will take some time to explain. So let's just look at the basics. PE ratio, price to earnings ratio, price to earnings growth, which is PEG, PEG. And on the PE ratio, you have your trailing PE and your forward PE. Trailing PE means what the price to earnings ratio has already been, and forward PE means that what it's projected to be. So that means that in the future, current estimates have the expected price to earnings ratio for this stock to be $42.15. Sorry, 42.15, not dollars. Excuse me, 42.15. So basically, what that means is if you look at the price of the stock versus the amount of earnings it's generating, the multiple is expected to be 42.15 times their actual earnings. Okay. Now, some stocks have really high P ratios and some have really low ones. So this is a relatively mid-level. 20 is like the lower end of normal. This is like the higher end of normal. If this were at 13 or 14, that would be extremely valuable. That would mean that you probably want to buy the stock now. So think of the yellow range as where you're more or less likely to stay. The yellow area is where the stock is going to spend the majority of its time. So right now we're at the higher end of that range. For price to earnings growth, the same thing. We're currently in the normal zone that we would be in for it. So when you look at valuation, what you're trying to figure out is where do buyers typically buy and where do sellers typically sell. So buyers will typically want to get in when the valuations are in the green because they would recognize that the stock price is relatively low compared to what the company's doing. So think of it like if you're buying a business and the business is still doing really well. There's nothing that's saying that it should do poorly, but because of some local conditions, the value of real estate is going down, or sort of value of businesses have gone down because maybe a lot of people can't afford to buy them. So you find it at a bargain, you get it, but there's nothing wrong with the business. It's doing all it's supposed to do. It's just you're able to get it at a slightly better price. So that's basically how stocks are usually looked at. If you ever want to know like what primarily drives decisions at the fundamental level, it's valuation. They take the fundamental data and then they figure out what they think that means as far as the future value of the stock, and then that will create the value that we see in the stock now. So a PE ratio is just a reflection of how sure the market feels about the future growth and earnings and profitability of a company. The higher the PE ratio is, the more the market expects there to be large growth. The lower the PE ratio is, the less the market thinks there's going to be large growth. So right now, based on where this PE ratio is, it looks like they're expecting some decent growth. But if I'm trying to buy in now, I would see this as a higher price point than I personally would want to get in at. I'd rather get in when the valuation is a little on the lower end. So for PE ratio, we're not in a really solid spot now. For price to earnings growth, we're in a decent spot. Price to cash flow is actually on the high side, right? So the price is pretty high compared to cash flow, but cash flow is not necessarily that important for some companies. So for this one, I think this is not as big of a deal. Price to book value basically just means how much the stock is worth based on the assets that they actually have. Assets includes everything: real estate, drugs, inventory, whatever that they own that's physically theirs would be part of the quote unquote book value. So the price to book value basically says how many times multiples is the price compared to the actual hard assets that the company owns. Price to sales, as you probably would guess, just says, okay, based on your revenue, the money you bring in sales, how high is your price? So just because a valuation is high doesn't mean it's wrong or doesn't mean it's bad. If the market sees that some new drug is going to dramatically increase, or expects that some new drug is going to dramatically increase the profitability of a company, then it makes sense to buy even though the price is at a high valuation, because that valuation will make sense later. Classic example is Tesla. Tesla had a very high valuation for a long time. It was in like the hundreds to one, even like thousand to one. But eventually, the company has been able to make good on the price value. So if I look at Tesla really quick, just as a comparison, I look at Tesla. Presently, it's trading at a P/E ratio of about 85. But notice up here, it shows the highest. It was 1724.8. So we're way at the basement for Tesla. But for a long time, people were trading that valuation. So what happened? What happened was earnings went up, and the earnings were able to catch up to the value of the price. That's all that happened. So that means that the people who invested earlier, who are willing to pay that high valuation, got paid out later when the stock actually caught up. So valuation, in my opinion, is always relative. You always have to look at what's going on at the time. For a company like an Eli Lilly or an Apple, the valuation is going to be very, very reliable. If it's on the lower end, buyers will typically show up. When you're looking at a hyper growth stock that has big future projections of value, but right now is still in the growth phase, you have to use valuation less. So I still like to look for valuation when it's in, when this score is in the yellow or green. That's the only time I'm interested. If it's in the red, even if it's a growth stock, I won't do it, because I know at some point that that price is going to come back and get into a more normal, reasonable range. All right. So in short, valuation is just a tool that you use to figure out where investors are likely to take action, and they almost always want to buy when the valuation is lower. They almost always want to not buy and sometimes sell when the valuation is higher.
So I would imagine that like red to yellow, moving through
Mhm.
the yellow is a good sign that the company's estimates are starting to come to fruition. And if you get the money flow and you get the inner circle buying and you start to see the technicals moving in the right direction, it's like this harmonious effect of making solid investments and everything coming together. And I believe that's one of the great values of having a tool like this, because it does help you visualize the story as it's taking place. So
Right.
really appreciate the analysis there. It does come together. Now, real quick, the chart below the gauge is the historical numbers for that ratio,
Yes.
basically, right?
But yeah, I forgot to mention that. So these are actually showing us the history. So you can see there's a line above and a line below. The red line is the top. So in trading parlance, we would say it's overbought, and if it's down here, we would say it's oversold. So basically, what this is doing is keeping a track record of where this value has been over time. That by itself, by the way, is a extremely good thing to have, because if I can get a sense for how this thing moves in terms of price to cash flow, etc., and I can compare it to different points in the past where the stock was able to make a significant rally, I can figure out the pattern, right? There's always a pattern to buyers in different stocks. Investors tend to be creatures of habit. So once they have a certain way of approaching things, which they would, a systematic approach, all we're doing is waiting to see where they typically come in. And once we know where that is, we can time our entries at the same time to get the maximum benefit from the wave of pressure they create to move the stock price up.
All right, awesome. And there you go, ladies and gentlemen. That is an in-depth review of Madison Trading Software valuation tab. And now, Mike, I won't be so confused when we're going over this section. So
All right, cool.
appreciate the insight. And
Yeah,
that's just to say how powerful the software is, right? When you start to know what you're looking for and the color grades start to make sense, I really do think that it helps investors, traders validate any of the ideas that they have. And so Once again, if you're watching, listening for the first time, and you're interested in taking a look for yourself, head on over to MadisonTradingSoftware.com. Grab a winner, watch some of our previous videos where we dig into all of the different features, and tell us what you like, tell us what you don't like, tell us what else you want to see. It's an evolving thing, and the goal is to build something that gives day-to-day traders, investors, money managers a tool to grow their portfolio, grow their winners, build on their trades. And so head
Yep.
on over to MadisonTradingSoftware.com. I'm gonna go ahead and throw the link in the chat again. All right, Mike. So we just had our Fed meeting last week. We've got some upcoming numbers: core PCE, unemployment claims, FOMC members speaking. Are we just kind of watching this market to see if we're going to break to new not new all time, but new lows for the year? Is that kind of what we're keeping an eye on?
I guess so. I mean, at this point, no, I'm not watching highs. I'm only watching where the lows are. So true. So that's what we really have to keep an eye on. Like, how much lower can we go? We are technically in a dangerous spot. I mean, if you're just a standard chart analyst, basically, if we break below the June lows, I mean, the last time the only place I can see that we've consolidated before would be back here, and that was in 2020, fall of 2020. So that's a long way back. What would be very interesting to watch is if we can bring the market back to where it was before the pandemic hit. Like,
And is
that's what
that
I'm
is
mostly
that is
watching.
that big sell off to the left there?
Yep,
That's
that's it.
the
So
pandemic.
yeah, so right here where my cursor is, right at that exact point, if we and that's basically at the mid range of where the last area of significant sideways trading was, and that was back in, like I said, fall of 2020, whereas where we are now is at the spring of 2020, or winter, I guess, depending how you look at it. But whatever the case may be, if we go back to there, we've literally erased all of the gains that we made post pandemic. And we're pretty close to getting there at this point. We've already retraced, I'm going to guess, 2/3 of the gains that we made. So that's a significant decline. Just to
And we're
say,
not that far off, right? We're
no,
only
we're
like
not.
150 on the spoos, right? 100
Yeah,
something like that.
yeah, we're very very close, and I don't think that's going to that's not going to look good um, for anyone. It's not going to make the Fed look good. It's not going to make the current administration look good. It's not going to make the economy look good. I mean, everything about that's going to scream, man, we're in trouble. Like, we this is not good. So, in short, um, the difference with the pandemic sell off was once it happened, we had all the Fed stimulus and everything come in that boosted the market back up. But now it's all over, and people are basically left to deal with the hangover of that long rally. Um, the last recovery, the last time we sold off and recovered, we did retrace a large percentage of the previous gains that were made in previous years. But this is different because the situation is not something that can be quick. There's no quick fix for this. And a lot of the problems we're facing are the result of the quick fixes we did before. So we're basically compounding problems, and I think everyone knows at this point we can't print our way. Money can't be printed to buy our way out of this anymore. It's over. That game has played itself out. The music stopped. Now it's time to face reality. Now it's time, to literally face the hangover of all that easy money that we've been getting since the last financial crisis, and even more since the pandemic began. So like I said, I don't have a very positive outlook on the market at all. I do expect a lot of volatility. There will be swings up and down. I expect that, but I don't see any way to just get out of this and continue like we did, post pandemic sell off. I just don't see that as a possibility at all. So with that in mind, keep an eye on the numbers that come out. Remember, the Fed's going to be on their mission, and the FOMC members are going to be speaking. Several of them are going to be speaking this week, before the end of the week. So I would definitely listen to what they, or at least look at the transcripts or summaries of what they had to say. But the last vote was unanimous for a rate hike, this last one. So there's no dissenters at all. If that's the case, then we need to figure out how hawkish they really are in their comments. And if they look really hawkish, then we know what's coming next. And I guarantee if every one of these guys says a lot of negative stuff, market's going to be selling off, into the end of the week and probably into next week.
Now, one thing we don't really cover much on the show is bonds, but all today I've been hearing that bonds are like really all over the place, and the Bank of England was making some serious moves. Is that something that you're keeping an eye on in terms of
Yes.
the overall effect?
Bonds are probably the single greatest indication of larger scale financial health for bigger economies. They say a lot. So, for example, here, this is the pandemic. You see that bonds shot up dramatically, which was something that was expected. In fact, that was a trade that I personally did. I bought bonds and sold off all my stocks before the pandemic sell off because I was convinced that the numbers were not looking good to begin with. In other words, 2020 wasn't looking like it was going to be a great year anyway for the market. And then when the pandemic hit, it was like, oh crap, this is over. So basically, bonds rallied strongly. Flight to safety, whatever you want to call it, getting people getting out of stocks and getting into something more stable. Sure. Well, bonds are now sinking, and why? Well, the rise here, in my personal opinion, was people were guessing, and they guessed correctly, that interest rates were going to get dropped sharply. Now, when interest rates go down, bond prices go up. It's an inverse relation. When interest rates go up, bond prices go down. So this slide that we've been seeing since then, part of it was the anticipation of what was to come. Also, we have some movements by the Federal Reserve selling treasuries, bonds to off their balance sheet after accumulating them for so long. But in short, bonds are basically in a massive, prolonged decline, and it's not surprising. The last time I saw this happen was prior to the financial crisis. We had a bond market that looked similar. Rates kept going up, bonds kept going down. I remember a guy who was a trader that when I started working, he was a big short the bonds, and he made a ton of money on that. He just kept rolling it and rolling it and rolling it, month after month, set quarter after quarter, as long as the rates kept going up. And of course, when things stopped finally, then the trade was over. So right now, bond markets are going crazy globally because we have big interest rate maneuverings. The UK is complex because they're trying to it's they're lowering taxes, they're increasing stimulus spending, and I think at the same time they're raising rates. It's like it's all over the place. So it's hard to figure out what the value of anything should be when you've got that many conflicting things happening. But it's almost like the UK just said, we're just throwing everything at it and we'll see what happens. Like, just throw everything in the washing machine and see what comes out. Um, our Fed has been more tactical and more focused, so I'll give them credit that their picture seems to be more stable, and I think that's one of the reasons why a lot of people are moving money and other investments into the United States now, because comparatively to Europe, our economy looks fantastic. Our economy is not fantastic, but it looks so much better than theirs that people want to go here. So a lot of that's going to continue. So stay tuned.
Yeah, stay tuned, folks. Should be shaping up for an interesting October. I'm pretty sure October historically is like a momentous month throughout
Supposed to
like
be good.
the decades of history, right?
Yeah.
So we'll keep an eye on that. All right. Once again, if anybody's interested in grabbing a demo of the software, head on over to MadisonTradingSoftware.com. If you're enjoying the stream, hit that like, hit that subscribe, hit that follow button. If you have any questions, feel free to drop it in the chat, send us a DM, leave a comment. Someone will get back to you as soon as they can. All right, Mike, thank you for your time today. Everyone, thank you for tuning in. With that, we're going to go ahead and close things out, and we'll catch everybody next week. All right,
All right.
guys.